All right, well, good afternoon, everyone, and welcome to our webinar, The Investing Potential of the Next Decade. Today, we're going to talk about how we're navigating some of the cyclical and structural changes that we're seeing in markets, and how we're thinking about building portfolios that we believe will be well-positioned to help investors meet their objectives, not just for today, but really over the course of the next decade. And as we move through the conversation, that word changes, I think, is one that's going to come up over and over. So it's something that I really wanted to call out and highlight kind of right from the start. But before we do get started, I want to highlight the resources tab, where you can find more of our insights and a survey to share your feedback on today's event. Additionally, please ask questions using the question and answer tab, and we'll get to them provided the time allows. My name is Jake Simoniak, and I'm a senior global equity strategist here at Manning & Napier. Today, I'm joined by my colleague, Jeff Ingram, managing director of our portfolio strategies group. The group works closely with our research department and is responsible for conveying the firm's views on the economy, capital markets, and really portfolio management and positioning. Before we move on, Jeff, could you tell us a little bit more about yourself and kind of what it is you do here at the firm?
Yeah, sure. Thanks, Jake. And thank you for our audience for joining us today. My role at the firm is really two-part. I think number one, I help synthesize the views and portfolio positioning of our investment professionals, and then meet with clients and sort of communicate that back to them. So not dissimilar to what you and I are doing here today. And then the other part of my job is I work very closely with all of our clients, our advisor partners, our institutional investors, to really understand their portfolio needs and their concerns, and then help bring solutions that either Manning & Napier or our parent company, Callodine, can offer to those clients. And I will say this, I've been with the firm about 13 years, but in the early part of my career, I spent about 10 years in the fixed income capital markets. So if I have a little bit of a bias towards fixed income or sort of put it on a higher pedestal, maybe that's the reason.
Fair enough. As an equity guy, I can appreciate that. So before we really get going, I'm going to do what I typically do at the outset of these and set the stage for what I think we're going to cover today. The conversation is really going to center on the cyclical and secular forces that we believe are most likely to impact the investment environment over the next decade. And obviously, kind of given the title of the presentation and Jeff's background, there's going to be a particular focus on the fixed income markets themselves. We want to be clear that these trends we're going to talk about have really been in place for years now, and in some cases, decades. And what we're seeing in terms of policy shifts from the US today is in many ways a result of some of the forces that we're going to talk about today. I think it's important to understand that it's not necessarily a reaction to what we've seen really over the course of the last couple of weeks or couple months. So the first thing we're going to do is talk a good bit about how we started the year, maybe both economically and in financial markets. We'll also talk a bit about the broad policy environment and how that's evolved. Second, we're going to take a look at what we've seen from the bond market in particular, really over the course of the last several decades. And I'm hoping that this provides the right context to help discuss some of the changes and the impact that we're going to talk about in the back half of the conversation. From there, we're going to talk a bit about the broad environment for equities and what it could mean for long-term returns, and really the potential competition for capital that exists now from other asset classes. After that, I hope we're really going to get into kind of the meat of the conversation and dive into some of the secular forces that are changing the world today and talk about how that could potentially impact the investment environment. And I think the thing that's going to be really important is that we expect the impacts of these changes to potentially result in a more volatile inflationary environment, a more volatile rates environment. And that volatility too is going to bleed into economics, it's going to bleed into politics. And from there, we'll wrap up prepared remarks and move into our questions. So, with that, Jeff, I'm going to kick it over to you, and maybe you can tell us just a little bit about the environment that we're sitting in today and kind of how we got to where we are.
Yeah, sure. So like I said, maybe I have a little bit of a bias for fixed income here. So I'm just going to start with a famous quote by the political strategist James Carville, right? And so maybe some folks listening will remember this quote. And he said, I'll paraphrase a little bit. He said, I used to think that if there was reincarnation, I wanted to come back as the president, which, I'm sure would be relevant today. And he was a Democratic strategist. You can imagine what he thinks. He said, or maybe the Pope, which strangely enough is also relevant today as we sit here, or a 400 baseball hitter. Again, sort of starting the new baseball season, relevant today. But he said, now I know I would want to come back as the bond market because you can intimidate everybody. And look, we saw this just the other day when President Trump first announced his tariffs in early April, and the equity markets sold off meaningfully, the president's advisors, they basically said, look, we don't care. This is the medicine for what ails us, no short-term pain for the long-term gain, et cetera. And it really wasn't until the bond market started to show signs of dysfunction in terms of yield movements, in terms of trading activity, that finally sort of President Trump and his advisors said, oh, people are getting a little bit yippy now. And so they announced that 90-day tariff. So I think when we talk about potential regime shifts or changes, a lot of it starts with, or at least certainly involves, the fixed income markets. And what we've been experiencing for the last couple of years now is basically the end of a monetary policy experiment. It was zero interest rates here in the US. It was negative interest rates globally, massive amounts of this unprecedented central bank buying or quantitative easing. And so what we are coming out of at this point is a very sort of what we'll call a painful transition period. But at least now bonds can offer some value to investor portfolios. But at the same time, as we've sort of noted on the page here, and we'll cover them in a minute, but you have these secular forces that are these, almost what I call immovable objects that are exerting this heavy pressure on markets. And some of them have push-pull dynamics, right? So there's some that are inflationary, some that could be argued to be deflationary. And so I do think it sets up an environment where inflation, interest rates, and economies, as you noted, are going to be much more volatile over the coming decade.
Yeah, I think that sums things up really well, Jeff. And we are going to move on. We are going to talk about those things. But as I mentioned earlier, I do think it's important to kind of provide the context for where it is we're coming from. So, when we look at what we've seen from really the broad bond market over the course of the last several decades, the trend has been pretty clear. Maybe you could walk us through what it is we've seen and some of the factors that contributed to this.
Yeah, I mean, look, at the end of the day, this is such a simple chart, right? This is just a chart of the 10-year Treasury yield for the last 40 years or so, ending in August of 2020. And yet, despite it being such a simple chart, I think it's very important for understanding the market environment and how it influenced what I'll call the psyche and the framework for investors for so long. And there's really three things I'll say quickly about this. First, as I've already noted, it covers 40 years. So it basically spans the entire professional investing life of most investors today, with maybe folks like Warren Buffett excluded. So this is really the environment that has defined most people's professional investing life. The second thing is, yeah, there are periods of time where interest rates increased for brief moments. But the long-term trend, as you pointed out, is unmistakable. And it is the unmistakable decline in interest rates from roughly 10% at the beginning of the period to less than 1% by the time we bottomed out in August of 2020. And I think related to that concept, if you look at the return profile that this generated for investors during this 40-year time period, and we've noted it in the box here, if you invested in the broad fixed income market, so treasuries and other areas of the fixed income market, you compounded at an annual rate of 7.6% with relatively low volatility of just 5.3%. So if I could just put those return numbers into context for a moment, the S&P 500 over this same exact time period returned about 8.9%. So certainly a higher rate of return as one would have expected, but the volatility was nearly 3 times as high. So your risk reward trade-off of investing in the bond market over the last 40 years was twice as good as it was investing in the equity market. So again, it was a very advantageous, favorable environment and return profile for the US economy.
And it really is incredible to look at that chart, right? I look at that and what I see is a 40-year period with a line basically moving from the top left straight down to the bottom right. And to your point, it's so simple, but when you start to look at some of those dates, you think about the crash in 87, you think about the dot-com bust in the early 2000s, you think about the GFC, like those are profound market events that essentially had very little impact on kind of the broader trend that we saw really over the course of the last 4 decades. And I want to focus on what you talked about specifically regarding the returns and the volatility. Can you maybe go into it a little bit, just what that's meant for investors and kind of the role that that's been able to play in a portfolio?
Yeah, I mean, so the psyche has been that bonds and treasury bonds in particular are a ballast to your portfolio during times of market stress. So that's one aspect of it. The second aspect of it is, hey, this thing is paying me a coupon, right? I get a little bit more money deposited into my account every month, every quarter, every, semi-annually, however often the coupon interest is being paid. And this bond that never really goes down in price. So it sort of stays at that level. Maybe it goes up a little bit, maybe it goes down a little. It never really goes negative, and I'm earning this interest the whole time. And it again serves as a ballast for my overall investment portfolio. So that's again the psyche and the framework that most investors have become accustomed to for the last 40 years.
Yeah, and certainly on the equity side of things too, it's also allowed people to continually lower their discount rates. Whether they are doing it explicitly or just implicitly, and it's that has had a profound effect as well on how people think about equity markets broadly. But I did mention at the start of this that the theme here is going to be change. And what's clear is that it has changed. Can you talk to us a little bit about that and what it's meant for returns and portfolios and bond markets at large?
Yeah, all those things I just said, the exact opposite just occurred, basically, right? And so now we
Hmm.
have an environment in which over this time period, you have annualized at a negative rate. So even after taking into account the interest income that you're still receiving from that bond portfolio, it has been more than offset by the fact that the price declines that have occurred, sort of commensurate with the rise in interest rates. And so now you have people really starting to question, why do I own fixed income? What is this meant to do in my portfolio? I thought this was the risk-free rate. How is it going down in value? And so I think this really sort of shook people up in terms of not just, again, investment portfolios, but the psyche of businesses and consumers as well. Oh, I thought I could always go out and refinance my mortgage at a lower rate. Where are you telling me these mortgage rates are 5, 6, 7, 8% now? Businesses have become accustomed to when they go to refinance debt, they are refinancing at a lower rate. Well, that's not the case anymore. So you have higher maturity debt that is replacing lower maturity debt as it comes due. So again, I think it is changing the psyche of consumers, business owners, investors, and maybe hasn't fully translated to the equity market yet, which I know we'll get to in a second here.
Yeah, and that's exactly where I want to go from here, right? This trend that we've talked about did not happen in a vacuum. And what happens in the bond market has the capability to spread to the real economy, to, equity markets, and that's exactly what we see here, right? So maybe you could talk to us just a little bit about kind of the effect that that downtrend in yields has had on valuations in the equity market.
Yeah, I mean, there's a direct link between the risk-free rate or prevailing yields and the price on equities, right? Because you're basically, as you pointed out, that discounting mechanism. And so if you are discounting all those future equity cash flows at a higher rate, that business is worth more. And as rates go down, people are looking to enhance their return profile, and stocks have been the way to do it historically because they offer a higher return. But there is a trade-off in terms of the valuation that you're paying for stocks. But basically, over this time period of declining interest rates, you have seen a commensurate increase in equity market valuations. Now, the data we're using here is the cyclic adjusted PE ratio, right? And historically, there has been a very strong correlation between long-term equity returns and the price you pay for those equities. And as you see this increase over time, it also increases your return if you are an equity investor. So I'll take the sort of most extreme example here as one. We started in the early 1980s at a cyclically adjusted PE ratio of about 10. That has grown to more than 30 times today. So if you think about it, that is a tripling of the equity market valuation. If we were to go back to that 10, the market would fall by 2/3. Now, again, that's a very sort of extreme example, but you can see that there was a clear pattern between a falling interest rate environment and a rising equity valuation environment.
Yeah, I mean, in many ways, you could argue that people have actually pulled returns forward, and that kind of gets us to where we are today. I think the thing that's particularly interesting, though, is we think about the long-term yield chart that we had up just a couple of slides ago, and how yields have broken significantly higher and clearly broken out of that trend. We have not seen a commensurate move in equity markets to date.
Yeah, look, I know one of the things they tell you is, hey, if you put it on the page, you don't have to read it back to the audience. I'm going to break that rule here right now. If you look back to August of 2020, you had a Fed funds rate of 0. You had a 10-year treasury yield of less than 1%, right? It sort of bottomed out at around 0.72%. and therefore a CAPE ratio, sort of a PE ratio, if you will, on the equity market at 31 times. Fast forward to today, we have this notable regime shift in inflation, in interest rates, and now the Fed funds rate is over 4%. The 10-year treasury yield is over 4%, and yet the CAPE ratio is actually higher. So that's where I get back to, look, the equity market has not fully discounted, has not fully reflected maybe a new regime environment that is not just higher interest rates, but as we've noted, sort of more volatile inflation, more volatile interest rates, more volatile economic growth.
Yeah, maybe the thing I would add to that too is lower expectations of forward returns, which is something we've kind of alluded to a couple times now. When you look at the cyclically adjusted PE sitting where it is today, around call it, somewhere between 31 and 33, you're talking about on a long term, which we'll call a 10-year time horizon, compound return of low single digits annually in the equity market. And you juxtapose that with what we've seen really, I mean, just think about the last 2 years, right? Where we had 2 consecutive years of greater than 20% returns in the equity market. And really, when you think about the chart that we started with long-term yields, it has made sense in that type of environment to, I mean, at the threat of being informal, to buy the dip. And with valuations where they are today, with rates potentially doing what they're doing, that is simply not well, it's potentially not the case. I think maybe the question that I want to put to you, within the context of the conversation that we've had thus far, it seems to me that there are real alternatives for investment capital that we maybe haven't seen in the more recent past. Would you agree with that? And do you think that, I guess, investment markets broadly have really taken that into consideration and started to position accordingly?
Yeah, I mean, look, I think you're absolutely right. I mean, for a decade, right, post global financial crisis, it was TINA. There is no alternative. We have to own stocks, because if we don't own
Yeah.
stocks, we are owning something that is offering a very low yield. In some cases, they would say an artificially low yield, right? Because you had this central bank buying a yield that in many cases was below the prevailing rate of inflation. So the only thing I could do was own stocks and hope for a higher return. Now, again, a lot of those equity investors were rewarded, certainly here in the US, maybe less so outside the US, and we can talk about that. But there was no real competition. And so, yeah, you could say, okay, maybe investors were justified in going out and taking the risk of the equity market in search of that higher return because there was no alternative. So I don't know what the opposite of TINA is, but that's where we are today. There are alternatives. I'm not sure if that makes as fancy of an acronym, but the reality is, as you've pointed out, if you look at the earnings yield on the S&P 500, as we do here, or if you look at where we're trading on a cyclically adjusted PE ratio and what that implies for long-term stock returns, you are somewhere in the low single digits. And when you compare that, and I'll call that the risky return, the risky yield, you compare that to other risk-free rates, right? A 3-month T-bill today at nearly 5%, 10-year treasuries yielding 4.5%, single A rated, so high grade corporate bonds yielding almost, 5 to 6%. If you really sort of work your way through that math, you go, well, hang on a second, what happened to that equity risk premium? Right? The equity risk premium, historically speaking, is, let's just say, around 3%. We're not seeing that here today. There are many measures that show the equity risk premium has basically gone away or even gone negative at this point. So again, it's a sort of a fancy way, I guess, of saying that the equity market is perhaps not reflecting the new reality of a higher interest rate environment.
So, Jeff, people who are on this webinar probably wouldn't know this, but you and I have known each other for a while now. We have conversations like this a lot. And I think one of the things that I really appreciate about having these conversations with you is you have an ability to break things down and really kind of get back to first principles. So if you could, maybe I'll start, right? When I think about equities, there's multiple ways to win, right? You can get your yield, you can get multiple expansion, you can get earnings growth. When I think about fixed income, what is it that really tends to drive the returns you see in those fixed income markets?
Yeah, I mean, in fixed income, there's only one way to win, and that's getting your money back. Right there, that's the biggest risk, that you don't get your money back. These are contractual cash flows that you're entering into for the most part. And so really at the end of the day, it comes to, what am I contractually owed by investing in this fixed income instrument? And essentially the way that it's sort of expressed in our lingo is the yield. And it's justified by this chart here. Over 95% of the return that investors in the fixed income market have earned historically has come from that yield. So that's why it's just so important to think in yield and yield terms alone when you're talking about the fixed income market.
I think maybe the other side of that too is when we think about the potential for a more inflationary environment, we think about the potential for interest rates to be more volatile. One of the things that immediately comes to my mind is the potential for interest rates to continue to rise. Does that pose a significant risk to my return profile looking forward in the fixed income market?
I mean, at the end of the day, yields rising is always going to be the risk in the fixed income market. But I think we also need to take it into context of, well, what am I getting paid to take that risk? And so here's one way to sort of tackle that challenge. If you go back, and again, we are sort of intentionally cherry picking what we know now to be the low point of the interest rate environment because it helps sort of communicate the point a little bit more clearly, if not, acknowledging it's a little bit extreme. But if you go back to where yields were in August of 2020, and you were expected to earn that coupon interest for that year, what we've shown here is how much did yields need to move on a 2-year security, a 5-year security, a 10-year security, or a 30-year security to basically wipe out your entire year's worth of interest income or your entire year's worth of return. And it's almost comical how low the yield moves needed to be. If you owned a 2-year treasury back in August of 2020 and yields moved just 14 basis points, you lost a full year's worth of return in terms of your price movement. Today, that number is over 400 basis points. And you can see how dramatically different the risk reward trade-off from yield moves is today relative to where were at that low point, again, roughly 5 years ago or so. So yeah, we would make the argument. There's other ways to express it. This is just one of them. But the term premium that you're getting paid to take interest rate risk right now is much more favorable. It's actually positive for the first time in many years. So there are a lot of measures within the fixed income market that are suggesting that, okay, the risk reward trade-off in this market has become much more favorable, and it hadn't been for the 15 years prior.
Great. I appreciate that. So, you know, I think you've done a really good job framing the relative attractiveness of the asset class, fixed income broadly, kind of where we sit today. I want to get to the back half of this conversation now and really focus on some of the structural changes that we think could be driving this regime shift that we are talking about today. I do want to acknowledge the fact that some of these topics that we're going to cover can be a bit political in nature. We're not here to take a stand one way or the other. It's our job to sit here objectively and try and observe what's going on in markets and think critically just about the implications, the investment perspective of what it is that we're saying in order to help our partners achieve their goals. So with that, there's 5 things that I think we're going to focus on explicitly. I think there's potentially other topics that may or may not come up, but those are elevated public debt levels, worsening demographics, deglobalization, rising populism, and the increased frequency of natural disasters. And I think the thing that we want to keep in mind here is really just the potential for, I guess, impacts on economic growth, upward impacts on inflation, or really inflation volatility, and also the potential to inject volatility kind of as these things change, as things are more unsettled directly into financial markets. So we're going to start with rising public debt. And I want to take this in 2 parts. First, I want to talk about the debt levels themselves and what they could mean. So could you talk to us a bit about kind of basically what's happened with debt levels, kind of where we sit today?
Yeah, I mean, essentially, this is the way of just expressing that the government has run federal deficits pretty consistently over time. That adds to the debt level. And we're expressing it here as a percent of GDP, just because that sort of normalizes it to how large is the economy, because the nominal level is just going to grow over time. And obviously, it's easy to make the case when you look at this, 80 some year chart, and you can say, okay, well, the only other time that we have had this type of buildup in the debt level and reached this point of the amount of debt as a percent of GDP was during World War II. And everyone can sort of equate the two and say, oh, yes, for obvious reasons, we were doing that. And then once the war ended, we knew we had to pay down that debt, and we did so. And then, we sort of forgot that fiscal discipline, if you will, a little bit. And now we have once again built up very high debt levels. Now, I think the other challenge here, of course, is that it is in, as you've noted earlier, I mean, it's in the political crosshairs all the time, right? Now, both parties have been responsible for deficit spending and therefore raising the debt levels. But at the end of the day, when you talk about what the federal government spends its money on, a lot of it is interest expense. I mean, I think it's the fourth largest expense by line item as we sit here today. It makes up more than 10% of the federal budget every year now. So I think that you have a large number, one that hasn't been seen in, basically a generation, one that is less supported today in terms of its number than it was, again, 80 years ago when we were fighting World War II, and something that is constantly going to be in the political domain. And I think, frankly, some of it is also what I'll call sort of intentional, maybe self-inflicted wounds, where we put this also what I would call sort of an artificial ceiling on how much debt we can actually have, which then just engenders these showdowns where we say, okay, are we going to raise that level or not? If we're not, if you don't come to the table and negotiate with us, we're going to be willing to shut down the government. Okay, then we come to the table, we just kick the can 6 months down the road. So we still have not come to an impasse where we can actually resolve some of these issues. So I think for all those reasons and more, this is something that is very important and obviously something that is going to be impacting markets in the economy.
Yeah, there's no question about that, right? And I think maybe the best example that's fairly recent that I can think of is what you saw in September of 2022 in the UK, where they essentially rolled out a budget where they attempted to address rising energy costs that stemmed from the war that had broke out in Ukraine and kind of what that did to energy prices in Europe. You had, essentially these unfunded guarantees in a country like the UK that runs a current account deficit and runs a budget deficit. So, you have to fund that with external money. You had a massive shock to sovereign yields. You had a massive shock to the currency, and it resulted in a change in government. Now, for some unlucky reason, the UK thus far tends to be the only major developed market that gets treated like an emerging market. And I suppose that's just bad luck for them. But it's also not, it is at least informative directionally. And to the point you've made, it's become a bit of a political lightning rod, which means that we should expect to see volatility with spending, with taxation, with policy. And I think that brings me to the second part of this conversation. This is not just a, a graph on a piece of paper. This represents real government spending, which in a lot of ways represents income for parts of the economy. So can you talk about how this focus on public debt might affect the economy and markets moving forward as it changes and whipsaws?
Yeah, I mean, ultimately, at the end of the day, the flip side of this chart, which is all this government debt, which has been built up by deficit spending, is an entity that is spending money into the US economy, right? And so it is economic activity, right? When the government is spending money, that creates economic activity. So I think the other takeaway from something like this, instead of saying, well, look, this is how much debt the US has built up over time, is to say, well, look, this is how much the US government has supported economic growth within the United States. And so as we talk about maybe decreasing this number, you have to also talk about, well, what impact is that going to have on economic activity when you remove that deficit spending that sort of started this in the first place?
Yeah, and I think maybe the last point I would make before we move on is we're talking about removing spending, but we're also likely to see an increase in spending at some point too. And as this has become more politicized, we should expect this to just become more volatile, lead to more volatility in the economy, financial markets, and specifically the bond market for the purposes of this conversation. So, I know that you and I could talk about this topic specifically for quite some time, but in the interest of time, I am going to move on and we're going to go to demographics. So, maybe I would just kind of turn you loose on this to talk a little bit about the way that demographics worldwide are changing.
Yeah, I mean, I used the analogy earlier of the immovable object. Like demographics is the ultimate immovable object, right? These are just trends that do not change on a dime, and therefore projections can also be made. So this is obviously historical, right? But there's projections that we'll show later. But as we can see, the population globally is aging. Now that's not a bad thing. Okay, so let me just point that out first. It's certainly not a bad thing for me. I have three kids. You know, the oldest just turned 13. I have a 10-year-old and a 9-year-old. I love the fact that we have our grandparents around and they're there to spend time with the kids. So the fact that the population is aging globally, largely a trend of that we are able to live healthier and longer lives, is a great thing, but it does have economic consequences.
Yeah, and one of those consequences is rising dependency ratios. And I think one of the things that's interesting to me is when I think about this and really think about conventional wisdom as it relates to demographics, that conventional wisdom would tell you that this tends to be a disinflationary, if not outright deflationary phenomenon. But I think there's reasons to believe that that maybe isn't the case or may not be the case moving forward. Could you tell us a little bit about that?
Yeah, so here's where one of those ultimate, as I alluded to earlier, sort of push-pull dynamics on inflation can come into play. Let me first just describe exactly what's going on here on this page, because it can be a little complex at first. So I would argue that with the graphic we're showing on the left-hand side of the page, it includes both the history we just covered, right, from 1970 through current, as well as projections to 2050. And I would say that for most of the lines there, with maybe Japan being the exception, you have a pretty steady, stable line for the 50-year period. And then you reach 2020 and you start to see pretty meaningful inflection points. Now, let me sort of explain now exactly what this number is and what it represents. It's basically saying for every 100 people that you have that are in the workforce, right? So those that are defined as being aged from ages 20 to 64. For every 100 people you have in that age demographic, how many people are in the 65 plus? So that's where that dependency comes in. The dependency being, of course, those older individuals are depending on care for other people, but they're also depending on the productive capacity of those that are in the workforce, because generally speaking, age 65, you retire, you're no longer producing, you are a consumer at this point. And you can see the table that accompanies the chart on the left-hand side, the table on the right-hand side shows the inflection point that you can see graphically on the left. And again, steady for a pretty significant period of time, and then an inflection point around 2020. And you can see where those numbers are expected to end up by 2050. And again, the reliability of these numbers is pretty strong because demographics of all things is that immovable object. And so what you have here is basically what we'll call a doubling of the dependency ratio. So for every 100 people that are able-bodied individuals in the workforce, they have to now support twice as many people that have sort of aged out of the workforce. And the reason that I would argue that this could potentially be inflationary is because a lot of what those out of the workforce 65 and older individuals are consuming are the types of services that do not enjoy the same types of disinflationary trends that those aged 20 to 64 are spending their money on. And so let me say that a little bit clearly. They are, 65 and older are spending a lot on services, healthcare in particular, that does not have the same type of deflationary trends that goods do. And so I think that's why you can make the argument that this is actually a much more inflationary trend that is emerging in the US, but globally as a result of aging demographics.
Yeah, I think that's such an important point too, because one of the things that somebody will say in response to the argument that we just made is, yes, you have a smaller workforce, but people are going to adopt automation technology, and that is going to enable us to consume, at a more disinflationary pace. I think the thing that's important is when you think about those types of services, specifically related to healthcare here, to use an extreme example, like I don't think we're going to build a robot that's going to take care of your grandparents that you mentioned, right? That's just the likelihood of that happening is low. And I think the other thing that's particularly interesting to think about is that especially with Japan, Japan stands out, right? Japan, you've seen the dependency ratio rising for decades now, and you have not necessarily seen a pickup in inflation. But one of the other things you had seen globally was a more free flow of labor across markets. And I know, we can argue about Japan and whether or not that's actually been a contributor there, given their immigration policy, but that's another thing that's coming to an end. and not an end, but something that's certainly slowing or potentially reversing. That brings us to kind of the acceleration of deglobalization. Um, Really, in light of current events, going back to COVID, I think there's a lot to dig into here. So I'm going to turn it over to you, kind of let you go, and I'll jump in as needed as well, or as interested.
Yeah, so I mean, look, we were working, as you know, we were working on these charts and these thoughts for 18 months, right? We've been talking about a lot of these ideas. It has just become much more relevant today because tariffs are what are in the headlines. But again, there are trends that were in place well before April of this year. And so what we're showing here is basically US imports of goods from either China or Mexico. So we're sort of cherry picking two different countries, admittedly, but I think they illustrate the point very well. So in the 1990s, the US was importing more from Mexico. Then in 1999, China, in 2001, China joins the WTO. And all of a sudden, you see this huge explosion of imported goods from China as they sort of enter the global stage. And I would say, generally speaking, not just in the US, this was a more global phenomenon. And companies throughout this time that we've highlighted here were encouraged to lower their costs by any means possible. So the pendulum swung completely in the direction of running your business efficiently. Now, in some ways, that also meant running it in a much more complicated fashion because you extended your supply chain across many different time zones, countries, shipping methods, languages, but it meant you were getting cheaper goods. And so we were sort of willing to withstand what was a much more complex supply chain in pursuit of that cost efficiency. Now, I think at some point it sort of reaches its logical end, and you say, look, we've almost made this too complicated. And that was probably brought to bear during COVID, where all of a sudden, as globalization had extended things across all these different, again, regulatory regimes, governments, countries, each of these countries also had very different responses to COVID. And there were border shutdowns in some areas, less in others. Who actually has the productive capacity? Because all of a sudden we need more of, PP&E. And so it really called into question the importance of having perhaps more resiliency, reliability, dependability to your supply chain. And so what you've seen accelerated really during COVID was a movement towards more what we'll call nearshoring, friendshoring, onshoring. Now, the trade-off was always that a lot of the reasons that those business processes went overseas in the first place was because of cheaper labor. That was ultimately the reason for it. Now, some of that labor disadvantage has decreased naturally as we've brought up the wages of those foreign workers. And yet at the same time, the cost differential has also come down because the technology has improved so much. So we can build smarter factories, right? Whether that's through automation or robotics, closer to home, whether it's in the US, whether it's in Mexico, whether it's in Canada, and not have to sort of sacrifice cost as much as we had to in the past when it was just that technology wasn't there and we just needed the cheap labor itself.
Yeah,
But I think as you can see, right, imbalances built up during this time, right? And that's what's been sort of acknowledged by consumers, acknowledged by business owners, acknowledged by politicians. And so there are these strategic and structural imbalances that have built up because of this, and trying to figure out the best way to untangle that is a little bit complicated. But I would note that, look, it took 40 years to build this. It does not get unwound in 90 days.
no, and I think the other thing that's important to mention too, you've talked a lot about business efficiency and maybe implicitly just kind of maximizing consumption of cheap goods and services in a lot of different markets. I mean, that is the end goal of producing cheaply in a lot of ways. With some of the changes that we have seen, it's clear that priorities and policy goals have also shifted, right? Efficiency is no longer the target the way that it was. Even pre-COVID, you had kind of the rise of potential global hegemons or competitions to global hegemony from the US in a way that we really hadn't seen since the Cold War in the form of China. COVID really highlighted the extent to which, healthcare and health policy could impact supply chains. And playing this forward, I think the thing that's interesting from the perspective of the conversation we're having is, again, disrupting these supply chains. Take COVID out of it, forget what it was. Disruptions to these supply chains resulted in financial market volatility, political volatility, economic volatility. And when you think about continuing and moving forward with what we've seen, doing this requires a lot of stuff. It requires a lot of changes. It requires a lot of disruption. And that is injecting uncertainty and volatility into a system that maybe hasn't seen it to that degree in quite some time. Now, I do want to move off of this slide and potentially get back to something I said at the beginning of my comments and talk about the rise of populism. And I think in a lot of ways, this is both a product of where we started with the presentation, thinking about the multi-generational decline in interest rates, what that's meant for equity valuations, what that's meant for home prices, and kind of what we've seen since then in terms of rising government spending, shifts in policy. I know we disagree on this, so maybe not disagree. We see it a bit differently. So I'm eager to kick it to you, but where I sit, I think that the rise in populism that we've seen has a lot to do with rising income inequality, which again gets back to things like those declines in interest rates, what that's meant for asset holders. It gets to globalization and kind of what that's meant for the middle class, especially in developed markets, and their ability to work those manufacturing jobs that potentially the generation before them um, had been able to work and earned kind of a strong living wage, where maybe they feel like they can't now. And I think this has put us in a position where policymaking today has become significantly more volatile.
Yeah, I mean, look, I think that's exactly right. I mean, uh, I agree that the globalization that occurred over the last 40 years definitely benefited consumers, right? Because the variety of goods we could choose from increased. The cost of many of those goods decreased pretty materially. I'll give one example, right? We just purchased a new TV the other day, 55-inch beautiful flat screen TV, $350. My parents were over for Easter. They said, "Oh, we just noticed you got a new TV. How much did you pay for it?" Okay, I told them. And they said, "Oh, yeah, it's time for us to replace our TV. Oh, the one that is smaller than this one, and you paid $1,200 for and is not internet ready." So that is just, again, one extreme example. But the amount of goods deflation that we got as a result of globalization was an advantage to consumers in the aggregate. However, it also meant that a lot of workers were displaced. It also meant that a lot more of the return on investment accrued towards the business owners and less so for labor. And so that was a dynamic that you had playing out in the US that's been well documented. And I think outside the US, as globalization efforts increased, I think it did allow a lot of the foreign population that were previously earning very low sort of sustenance wages to earn a higher wage. Now, a wage that was still far lower than what we sort of earn here in the US, but better on relative terms than what they had. But as those individuals come up the wage spectrum, they start to say, hey, we want nice things too. Hey, we all of a sudden, we care about our lifestyle. We care about our health. And so they start to demand more of their government too and say, hey, where's my fair share of things? So I think you start to see this play out on a global scale. And I think the tipping point often becomes, look, another comment on inequality is everyone hates inflation. Everyone hates paying more for something. For whatever reason, we are naturally conditioned to want to buy things when they're on sale, buy things when they're cheaper. And so inflation was a global phenomenon in the post-COVID period. And so I think in many ways, it's no surprise that as we've highlighted here in 2024, nearly half of the global population was holding elections. And I believe the Financial Times reported pretty well on this. the parties in power in 2024 that were up for election all lost seats for the first time ever. And so I do think that is a reflection of both the inflation environment and how much consumers hate inflation. But I think you also had this undertone of inequality and sort of rebellion against globalization that was brewing. And again, a lot of the parties that ended up taking seats in the elections that we're pointing out here were more populist oriented parties.
And Jeff, what's so interesting to me in this conversation is this is where you start to see kind of the circular references and kind of the reinforcing dynamics that we've talked about moving through the conversation to get where we are now, right? We've talked about volatility, rising spending. We've talked about change and that, that inflation, that volatility ultimately yielded itself in this frankly incredible dynamic that we saw in 2024 when all these major parties in power switched out. And the result in a lot of instances has been significant change, right? You think about deglobalization stemming from the US with tariff policy. You think about, you put that in the context of the German election that we saw a couple months ago. And now you have this massive switch in fiscal policy where you have a country like Germany that's been a fiscal anchor in Europe really for the last couple of decades come out, change the constitution, edit their debt brake, and now they're talking about spending a low single digit percentage of GDP on infrastructure over the course of the next 10 years. That's a significant change, right? That is the world functioning in a way that it has not up until this point. And I think in a lot of ways, that really kind of gets at the crux of the conversation we're trying to have, where these changes that we're seeing in the world are leading to real changes in economics, and that's filtering into financial markets as well. So the last thing that I want to talk about before we kind of wrap this up and move on to Q&A, because we do have some really good questions that I want to get to, is the rising incidence of natural disasters and kind of what that means for planning purposes.
Yeah, I mean, at the end of the day, these are the known unknowns. So on the one hand, we know that they are going to occur. We can acknowledge that they are occurring with greater frequency. And we can also acknowledge that not only are they occurring with greater frequency, but also of greater magnitude, right? So greater destruction. And so that severely impacts economies in terms of the rebuilding effort. It severely impacts sort of global supply chains, especially when it comes to commodities and commodity production. And so it just introduces that next level element of elevated risks that are sort of unpredictable in nature. And if you go to anyone and say, hey, we have this unknown risk, it's going to be more frequent and in greater magnitude. And you say, well, what should a market's reaction to that be? And it should be, well, we have to price in a greater risk premium, right? Because we have to acknowledge that there's going to be greater volatility. And so the reason that we've highlighted all of these different secular forces is because I think at the end of the day, it allows us to sort of underline the fact that, yes, we were in a 40-year declining interest rate environment and a relatively low volatility interest rate environment. And every economy was moving sort of lockstep in the same direction. The forces at play today are the opposite in many ways, right, of what led to that 40-year time period. And so you sort of start with the conclusion that, okay, let's start with the bond market, right? The bond market, that 40-year bull market, own bonds, set it and forget it, get a twice as good risk-adjusted return as the stock market. That is not a reality that we are going to face over the next 40 years. I think the good news, and I think one of the audience members put it in their question, is the prevailing yield that you see in the fixed income market is your best estimate and is a high probability predictor, high confidence interval predictor of what your return expectation should be. So hey, when bonds yielded zero, you should have expected zero. You shouldn't have expected the historical 7% that you got. But now that bonds are starting to yield 4, 5, 6, 7, 8%, depending on which part of the market you're talking about, it sets it up for much more favorable forward-looking returns than what we've seen over the last 5 years as we've gone through this transition period out of the monetary policy experiment that I alluded to earlier. And yet at the same time, this is not going to be, oh, well, bond yields are going to go to 4% and just stay there. And so you won't get any volatility. I think we've already acknowledged a lot of the dynamics at play. I would argue that on balance, in the aggregate, are underlying inflationary. And that supports higher yields. But I think it also introduces a lot more volatility because we're not used to it. Consumers hate it. The political environment is sort of less reliable under a more inflationary environment, on top of the existing high debt levels we already have that introduce their own level of volatility. So I think ultimately, at the end of the day, the conclusion needs to be that your toolkit for investing for the next 40 years has to be very different than what you had for the previous 40 years.
All right, this is typically the part of one of these where I would jump in and try and wrap things up, but you just made my job much easier and did that for me. So, I think in the interest of time, and because we do have quite a few questions, some good questions in here too, we're going to jump right to the Q&A. So the first one I have, Jeff, I can't see the Q&A, so if you can see it and pull it up, I have a lot of pre-submitted questions that I can rip through. Jump in with any that you got too that you want to touch on.
Yep.
I'm going to start and I'm going to take this one. It asks about the effect of existing tariffs specifically on GDP. And I think there's two ways to answer this. The first is I can say, we can look at models, we can say there's going to be a 1 to 1.25% hit to GDP from tariffs at the level at which that was calculated. But the reality is there are second and third and fourth and fifth order effects that are simply unknowable. And that's on top of the fact that this has become, always has been really, a moving target. They change often and we just don't know. And that just don't know, I think, is what I want to focus on. I think about where we were to start the year. The US economy had been growing above trend for a couple years now, but was clearly slowing before any of the tariff effects came into place. If you were a business and you were attempting to plan for the future, the current environment is simply not conducive to that. So I don't feel confident that I can sit here and give a point estimate about what the effect is going to be on GDP growth in the US. What I do feel very confident in saying is that, we were growing above trend, we were slowing down towards trend, and this presents nothing but downside risks in the short to medium term. I think you can make a bull case, but to the extent that you can, you're talking about quarters, if not years out, really resulting from rising business confidence, deregulation, and investment in the US. The type of investment you need to move the needle takes years, not months.
Yeah, I mean, I don't have anything to add there other than the comment that the tariff policy as currently laid out has been highly unpredictable. And that is a generally bad operating environment for consumers, business owners, and investors. And so that's why you're seeing it reflected in the market activity that we're seeing today.
All right, I'm going to toss a question to you then. So do you see market returns broadening or remaining narrow?
Yeah, so I think the nature of this question is probably the fact, something we've written about and talked about extensively, where market returns in the US in particular have been dominated by just a small handful of stocks that have earned themselves the acronym of either Batman, if you want to include Broadcom in there, or the Magnificent Seven, right? So those are those 7 stocks, all within sort of the realm of technology and artificial intelligence. They have become, the 7 largest companies in the US market. And therefore, because the S&P 500 is market cap weighted, they represent a disproportionate amount of the return of the S&P 500. And because those 7 stocks have done so well, the index itself has done incredibly well. So just to put some numbers behind that, in 2023 and 2024, the S&P 500 was up about 25% each of those years. The average stock in the S&P 500 is up only about 13%, so half that number. So that speaks to what could be defined as the narrowness of market returns. I think our view is, look, the pithy response is trees don't grow to the sky. So eventually, the law of large numbers sort of prevents those companies from getting that much bigger, continuing to compound at the rate they have, because they would sort of take over the world at that pace. So that's sort of the easy, maybe a little bit wonky math answer to it. I think the more realistic answer is they benefited from the environment that we talked about that just dominated the last decade, which is a declining and all the way down to zero interest rate environment and free trade and globalization. They were the primary beneficiaries of that. If we are talking about a regime shift away from that, which we are today, it would also suggest a regime shift that is not as beneficial to those companies. So I would expect a broadening out of market returns as we go forward.
Yeah, I don't have much to add to that. I'm going to move on to a quick question. And again, I think I'm going to take this one, Jeff. Thoughts and tools regarding investing in India. So when I think broadly about investing in emerging markets, and I'm going to try and be quick about this, I kind of put the countries into 2 buckets. Very simply, I think that there are countries you buy to sell, and there are countries you invest in. I think about a country like Brazil. I even think about a country like South Korea or Taiwan that's significantly more developed, but is highly levered to incredibly cyclical industries like the semiconductor industry, where you get very, very volatile and very pronounced cycles. Those are markets that you typically buy with the intention of selling and buying back again. India is in the latter bucket. To me, it's a market that you buy with the intent to hold. You don't have the same type of cyclical dynamics or political volatility that exists elsewhere. And you have some of the, I say some of, you have potentially the strongest kind of secular dynamics at your back that you'll find in any market in the world. So to me, that is a market that belongs in a portfolio. Now, I think there's challenges with investing. Valuations in particular are one. You've had a market that until Modi got elected in 15 or 16, traded kind of in the mid to high teens, and since then the average multiple has moved up into the low 20s. If you find the market trading up around 23, 24 times, think about managing your position. Conversely, if you find yourself in the low 20s, I think it's a market you want to be looking to potentially gain more exposure to. But I think it's a market that's certainly worth taking a look at, and to the extent you can, belongs in a portfolio.
Yeah, and I'll just add something just maybe a little bit more technically on like how do you invest in India for just a little bit here. And so India is notoriously actually a very difficult market for individual investors themselves to invest in. So you can't just easily buy stocks that trade on the Indian Stock Exchange. So you have to look at different vehicles to help you access that market. And I believe there's probably an India ETF that exists out there. So that would be one option. And that's just sort of a broad approach of, okay, I just own everything in India. If you do want to take a little bit more targeted approach, which I think myself and most other sort of portfolio allocator advisors would suggest, is when you go into emerging markets, you actually do want to be selective in the companies you own and the sectors you're exposed to. And so that leads you to, okay, well, if I invest in an emerging markets fund, that emerging markets fund is not just investing in India. In fact, probably a lot of its investments have to be in China because China is the largest emerging market. Well, I didn't want all that China exposure along with it. So now you say, well, what if I invest in a manager that has the ability to invest in emerging markets, but it's not their sole mandate? I would argue, I think we as a firm would argue that's a better approach to things, because the investment professionals are going to be sort of closer to the decision, closer to the ground of the dynamics that are taking place in global markets broadly, in emerging markets more specifically, and India sort of narrowly, and then the specific sectors and companies you want to be in. And that manager that can invest in both developed and emerging markets is sort of making that decision, that capital allocation decision. And to use your example of not just India, but also, hey, look, maybe there is a trade to be had in owning, stocks in Brazil. And so having the ability to do that as well, I think is very advantageous.
So we're kind of right up against time here, but there is one more question. Two questions really that I think are fun and tie pretty well, not only into the content we're talking about today, but current events more broadly. And I'm going to throw this out there and maybe we can kind of get through it quick. And if we need to, write out a longer answer and get it out. But with I guess, how important is it for US equity markets? How important is it for the US equity markets for the US dollar to remain the world's reserve currency? And what's the chance that the USD gets replaced by a basket of currencies? You want to start with that, or how do you want to do this?
You're the global equity strategist. I'm going to put that in your plate first.
So, how important is it for US equities, for the USD to remain the world's reserve currency? I think less about, in the context of this being a reserve currency, and more about the size of the deficit that we run and the dollars that we send out into the world that then have to be recycled and put to work somewhere. When you think about the amount of US dollars that get spent, that get lent out overseas, those dollars have to go somewhere. And one of the most compelling opportunities for decades has been US equities. Now, I don't think that necessarily has to do with being a reserve currency in the world. To me, it is the product of a lot of things that have made this country kind of what it is, whether that's a predictable business environment, kind of the quality of company that exists in the US market. And I think the other thing that's really interesting is really just the lack of opportunity elsewhere, whether that's real investment, whether that's the ability to invest in companies that have been levered to global trends that have really run over the course of the last 10 or 15 years. So when I think about that question, I don't know that the US remaining the world's reserve currency in and of itself is necessary for US equity markets to continue to dominate in the way that they have.
Yeah, I mean, look, at the end of the day, we sort of in the beginning forced ourselves to be the world reserve currency. Now, other governments were okay with that, right? So I'm talking about the post World War II Bretton Woods era.
Yep.
All of you trading partners, you're going to link your currency to ours, and don't worry about the faith and credit of the US government because we're going to back it by gold. And so that regime existed for 25, 30 years. When we went off the gold standard in the early 1970s, we had to justify our place at that point as the world reserve currency. Now, we had a head start, right? And we could argue we had a 30-year head start, right, with Bretton Woods. But the fact that we had the most dynamic economy, the freest flow of capital, we had the most stable sort of political system. I think that afforded us the ability to basically prove our worth as being the world reserve currency.
Most aircraft carriers.
There was others, yes, yeah, right. Very strong defense, right? Thank you. And so I think at the end of the day, we earned it, okay? And the higher returns that have been generated over time in the US market are reflective of those things that allowed us to earn that reserve currency status. So if we were to lose that status, I would argue that it would be an incredibly major and disruptive political event, geopolitical event, and that itself would be bad for equities. So it's not just losing the status, it's the reasons why, it's the events that lead up to it. If this were a more methodical process that was also allowed to play out over 40 years, maybe it would be less disruptive. But show me any politician that has a 40-year plan that they're willing to stick to and pass through.
Yeah, and then the second part of that question is what's the chance that the USD gets replaced by a basket of currencies? To be very short and blunt, I think the answer is low, or the chances are low. I don't think you have a great alternative. You know, I don't think there's any point in having a conversation about something like gold or Bitcoin. It's just the idea of that happening is we're so far from that being the case. I think the idea that there is a better alternative to the dollar right now, if somebody thinks they have one, like let me know. I just don't see that out there.
Agreed.
All right. Well, with that, we've come to the end of the time that we have for today. If we didn't get to your question, we'll be sure to follow up with you after the presentation. Please continue to reach out with any additional questions or follow-up you might have. As a reminder, for your convenience, a recording of this webinar will be emailed to you shortly. And again, feel free to explore the resources tab for additional insights. Jeff, thanks for being here today, and to our listeners, thank you for attending today's webinar.